In this video, I'm going to be going over the High Yield Dividend ETF SPHD. Now, this is not an ETF that I own currently, but it is an ETF that I did own in the past before I replaced it with JEPI. So I'm going to give you all a brief summary of this ETF. I'm going to go over its holdings, its investment methodology, the industries it invests in, and also the dividend yield and dividend growth. And before we get into the main topic, if you do enjoy this content, give this video a like. It will be greatly appreciated. It will help this video get out there to a wider audience, and also subscribe for future content. Now, SPHD is the Invesco S&P 500 High Dividend Low Volatility ETF. As the name suggests, it is dedicated to giving investors high dividend yield. Now, for a high yield dividend investor who wants diversity, this is actually a great choice of an ETF because it gives you diversity with the number of companies it invests in. Now, the investment methodology is pretty simple. It's composed of 50 securities traded on the S&P 500 index that historically have provided a high dividend yield and low volatility. So this ETF provides investors with great diversity into 50 different high-yielding dividend stocks. Now, not only is this ETF diversified with the stocks it chooses, but it also is diversified across industry as well, with utilities being the #1 holding here at about 20%, followed by consumer staples, real estate, and then healthcare. And then after that, no single industry has more than 10% of the overall holdings. But you do see energy, communication, services, materials, all coming in over 5%. So you can definitely see that there is still good industry diversification in this ETF. Now, looking at the top 10 companies of this ETF, these are all dividend paying companies that I'm sure many high yield dividend investors know about all too well. Many of these stocks individually are bought by investors that are looking for high dividend yield. We have Altria Group, Verizon Communications, Kinder Morgan, AT&T, Bristol Myers Squibb, Crown Castle, Dominion Energy, Vici Properties, Philip Morris International, and Simon Property Group. So as you can see, all huge high dividend paying companies, which definitely helps get that dividend yield up there a bit. And again, all of these companies are well established, and again, I'm sure many of you know it all too well. Now, the expense ratio of this ETF is somewhat high compared to other index tracking ETFs, but all things considered, for the diversification and what you get, you do get a relatively low expense ratio at 0.3%. So it's still going to be higher than ETFs like VYM and SCHD. But still, it is not so exorbitantly high that you may choose another ETF over this one if you are looking for high dividend yield. Speaking of dividend yield, the current SEC 30-day yield is sitting at 4.09%, which is going to be higher than ETFs like SCHD and VYM. And that is particularly because this ETF specifically tracks the highest yielding securities with the lowest volatility in the S&P 500. So you really get all of the high yielding companies instead of all of the lower yielding companies that more screen for quality, like in ETFs like SCHD and VYM. You're really not going to get companies that are screened using financial ratios or other factors. You're simply going to get the 50 highest yielding companies in the S&P 500 with low volatility. Let's get into the dividend payments right now. So the dividend payments are monthly, which is another reason why investors do love this ETF. Every single month, you get paid approximately at the final week of the month a dividend, which is great for people looking for that steady income. I know a lot of people base their expenses at a monthly rate. So this ETF is great for planning those monthly expenses. And you do see here that the dividend does jump around a little bit here and there. Now, the problem with this ETF is that overall the dividend does not grow that much. As you can see, we're going back several years, and the dividend yield now, or the dividend it's paying now, is barely higher than it was 3 to 5 years ago. But if we do go back pretty far, we can slowly start to see some dividend growth happening over a long time period. And as you can see here on Seeking Alpha, the 5-year dividend growth rate is actually negative. It's about 1% negative, call it, which is a terrible thing to see as a dividend investor. You know, most dividend investors want to really grow that yield on cost, but with SPHD, unless you're holding for a very long period of time. As this indicates, you generally just don't see that. You do get the higher dividend yield, which is great, but you don't really get that dividend growth over time. So you are definitely going to expect to see the same dividend payment month after month and even year after year for the most part. And as far as the price appreciation goes, this is without dividends reinvested. You do see some pretty decent 10-year growth overall, considering that this is a high yield dividend ETF, and many of those companies don't really grow in capital appreciation. The investors get payouts, which doesn't really contribute to investing back into the company. So that's what the investors get from this ETF. Mostly you get that dividend payment and income. You don't really get price appreciation, although you do see price appreciation over very long time periods. Like 10 years, you see a 55% price appreciation, which is great if you think about it when you add those dividends on to that. But comparing to SCHD, you see that SPHD does come up quite short, about by half. So SPHD rose in price 55% without dividends reinvested, where SCHD rose in price 114% without dividends reinvested. So it just goes to show that compared to some other high yield dividend ETFs that do include high yield dividend stocks, SPHD does come up short. As I said previously, I did own SPHD before I sold it for JEPI, and you could probably go back about a year ago in some of my older videos, which did discuss me owning the ETF. And basically the reason why I sold out of SPHD and bought JEPI is because I generally like JEPI's overall methodology more than SPHD. Now, JEPI is also a high income ETF, but it gives you income through a combination of selling covered calls, let's just say, and paying dividends from its underlying holdings, where SPHD is strictly conventional and the income you receive are strictly from dividends. Now, the yield of JEPI is quite a bit higher, and it also pays monthly, and it's really designed for a lower volatility compared to other ETFs. So I bought this ETF instead of SPHD because I wanted a yield ETF, and this ETF was just better. And also its underlying holdings, I believe, are better as well. They definitely have a lot more room to grow than SPHD's holdings. Overall though, I just wanted an ETF that seemed solid and also paid a high yield on the income. So I chose JEPI over SPHD for that reason. Please remember, if you did enjoy this content, leave this video a like to get this content out there to a wider audience, and also subscribe for future content, and I'll catch you all in the next video.